Market indices are at record highs. Corporate margins are the widest in decades. On paper, the rapid integration of artificial intelligence is an absolute success. For over a century, technological progress followed a predictable pattern. Automation destroyed specific jobs, like film developing or travel booking, but the increased efficiency always generated enough new economic activity to absorb the displaced workers into higher-paying roles. Current AI agents operate with a different logic. These systems perform the core reasoning and research tasks once reserved for the human middle manager. They function as a direct substitute for human cognition, rather than a tool that requires an operator to function. The global economy is built on the intelligence premium, the fact that human thought was a scarce and expensive resource. When machine intelligence becomes abundant and essentially free, the market value of human cognition collapses. This creates ghost GDP. Productivity spikes because a single GPU cluster generates the output of 10,000 workers, but that output circulates entirely within the tech sector, bypassing the consumer. A perfectly functioning AI removes the need for human payrolls. By eliminating those salaries, the technology removes the very wages that capitalism requires to buy its products. For an individual corporation, replacing a mid-level product manager with an AI agent is a clear win. A person earning $180,000 a year is replaced by a digital agent costing $200 a month. Corporate profits surge as labor costs vanish. This transition is hitting the top 20% of earners, the software developers, consultants, and analysts who were previously insulated from automation. This chart shows the risk. While this demographic is only a fifth of the population, they are responsible for 65% of all discretionary spending. They are the primary engine for the entire consumer economy. As these high earners lose their salaries, they stop spending on everything from home renovations to restaurant meals. When those non-tech businesses see their sales drop, they are forced to invest in AI and reduce their own staff to stay profitable. Every dollar a company saves by automating a high-earning role is a dollar removed from the aggregate consumer budget. Corporate efficiency is acting as a direct extraction from future demand. Significant portions of the economy rely on friction, the time and effort required for humans to make decisions. Trillions of dollars in value are tied to brand inertia, passive subscription renewals, and the inconvenience of switching services. AI agents remove this friction. They work in the background 24/7 to find cheaper delivery options, cancel unused memberships, and route payments around the 3% card interchange fees. Moats built on human laziness are disappearing. This creates a crisis in the private credit market. Lenders gave billions to software companies under the assumption that their recurring revenue was permanent. As AI eliminates the friction that protected that revenue, those software companies are beginning to default on their debt. This credit contagion is now moving toward the $13 trillion residential mortgage market. The residents in these high-value zip codes have 780 FICO scores and flawless credit histories. However, they borrowed against a future where their cognitive labor would always be in demand. As their industries are cannibalized by AI, their ability to service these multi-million-dollar loans is vanishing. These homeowners represent the bedrock of credit quality. Their impending default isn't a result of poor financial planning, but a result of their primary asset, their intelligence, becoming an abundant commodity. The government faces a structural trap. Most federal revenue comes from taxing human time and effort. When people work, the government takes a cut of their income and payroll. As the number of high-paying jobs declines, federal tax receipts drop. This is happening at the exact moment the government needs to increase spending to support millions of displaced workers who no longer have a path back to their previous income levels. Former Fed Chair Kevin Warsh described the current situation as a daisy chain of correlated bets. The entire financial system was built on the assumption that white-collar productivity would grow indefinitely and continue to fuel human salaries. Lowering interest rates or printing more money cannot resolve this. Those tools manage the supply of currency, but they cannot restore the scarcity of human thought. The underlying issue is that machine intelligence has broken the circular flow between corporate output and household income. We have to build a new economic framework that can distribute the wealth of machine intelligence. The current system relies on a human-centric model that is no longer compatible with the scale of AI output. The premium paid for human intelligence is disappearing.
Rebuilding the economy to function without that premium is the last uniquely human task left, and we must complete it before the existing system reaches its breaking point.